He's Michael Amey, Managing Director and Portfolio Manager at Pimco in London. Michael, just tell us what it is specifically that you're looking out for in today's budget.
Okay, I think the broad macro picture is already with us. It's one of continued fiscal austerity, as you said. You know, the next 3 to 4 years is going to see 1 to 1.5% taken off growth as a result of the spending cuts. And against that, we want to see that plan. You know, we want to see that plan being stuck to, because if that plan is stuck to, it allows the Bank of England to continue to keep rates low, and I think gives us a game plan to get out of this at some stage, you know, in the middle of this decade.
You think the government should stick to its austerity, but what about growth? It needs growth as well, doesn't it, to bring that deficit down?
Sure, and there are two ways you can get growth. You can get growth by spending more money at the government level, or you can get, which of course would risk, you know, us losing some of our credibility, which would come through in a weaker exchange rate and higher inflation, or you can allow the austerity measures to come through. And try and give the Bank of England as much flexibility as it can to stimulate short-term growth in recognition that, you know, we simply have too much debt and we've got to work it down.
Is the Bank of England doing enough with that flexibility? If the government's depending on the Bank of England to stimulate growth, can't it do more?
Well, it could do more. I mean, if it were to take the next step would be for it to come to some arrangement with the government whereby these infrastructure bonds were, you know, either issued direct to the Bank of England, for example, which would be a pretty big step. So that there are things they can do, which have been floated by 1 or 2 of the NPC members already. So it's not as if we run out of bullets. It's just a question of willingness to use them.
You say it's very important that the government stick to its plan. Is that because of the threats from the ratings agency? Do they really matter? It's not hurt France and the US too much losing their AAA.
No, the rating agencies are not relevant to this. The relevant aspect to this is the markets and the market's assessment of the UK's, you know, future prospects, and that really comes through in the exchange rate. The UK is pretty sensitive to changing the exchange rate, particularly the inflation numbers, as we've seen in the last few years. So as long as we can keep the exchange rate relatively stable, keep policy relatively credible, you know, that's what matters, not what the rating agencies think.
Isn't this an area, though, for flexibility? The exchange rate, if that were to come down, that helps UK exporters. What is the future for the pound?
Well, think about what's going on at the moment. If you compare the UK with places like Spain, for example, where, you know, the debt and deficit numbers are pretty similar. They have a stressed banking and housing sector. You know, Spain is in recession, is going to stay in recession. We think that the UK will avoid recession, but the growth is going to be pretty weak. So even now, the fact that we have that currency flexibility is giving us quite a big advantage relative to people in a pretty similar situation who don't have that currency flexibility.
Let's talk about Gilt now, because this is specifically your area. How can Gilt yields stay at these lows, these historic lows? Is that the future? Are they going to stay here?
I think they will stay pretty low, yeah, for the next few years. Put simply, because it's going to be pretty hard to get growth above trend, and if you can't get growth above trend, then it's going to be pretty hard for the Bank of England to raise interest rates. Now, the Bank of England has already told you that they're more worried about growth really than the inflation numbers. So that suggests to us that, you know, short and intermediate gilts will probably stick around here. Longer term gilts, you know, when you move away from, you know, the valuation being as much on what the Bank of England's thinking today, and you think about where inflation is going to be over the longer term, you know, I think longer term gilts are a bit vulnerable over the next few years, frankly, simply because, you know, inflation has been sticky, and we think it will stay sticky.
So what does this mean for your strategy? How do UK gilts compare to Treasuries, German bunds?
Okay, so gilts yield about 2.4 at the 10-year, Treasuries yield about 2.3, bunds around about 2%. Now, of those, we think that the bunds are the most vulnerable, simply because, you know, at some point we think that the Europeans will integrate more fully. Life will probably get worse for the Europeans before it gets better, but ultimately, you know, if the Germans integrate more closely with Europe, then there will be a credit premium put into the bund market. So we think they look a little bit expensive relative to gilts and Treasuries. After that, you know, gilts and Treasuries yielding pretty similar levels, you know, pretty similar central bank policy framework. So be more agnostic between the two of those.
And what's the big wild card? What could change things for the worse for the UK? Are you worried about the oil price, or are you worried about the situation in Europe getting worse, as you say it may do?
So Europe is by far and away the biggest risk to the UK, and the main reason for that is our banking system is still pretty heavily levered. Our economy is still pretty heavily levered. So anything that knocks us off, you know, this relatively low but positive growth course in a big way and forces, you know, accelerated delevering would be the most unpleasant outlook for the UK, and that really would emanate from the Eurozone.
Michael Amey, Managing Director, Portfolio Director at Pimco Europe, we thank you very much for your insights today.